There's a ton of inventory to choose from. So buyers have more time, they have more leverage, there's more negotiating room. And so buyers really do have the cream of the crop to pick from.
Data from Redfin shows that sellers in the Austin area outnumber buyers by 130%.
They said Austin couldn't fall, that it was different, built on tech dreams, Tesla cash, and California migration. But the cracks started small. A canceled build here, a price cut there, then silence, the kind that fills an empty open house on a Saturday afternoon. Now, the market that once felt unstoppable is showing nerves. Prices are softening, agents are hustling harder, and homeowners are realizing the gold rush is over. This isn't collapse, it's correction with a heartbeat. And it's testing who really understands this city and who just rode the hype.
Right now, the median home sale price in Austin is $508,000, down more than 9% from last year. But the market is not without challenges for first-time home buyers. Kerr says as the state's high property taxes drive up monthly payments, it keeps a lot of would-be buyers out.
Quick snapshot. Prices are lower than a year ago in much of Austin. Months of supply has climbed into neutral to buyer territory, and rents are softening, which means opportunity and risk, depending on it's your position. The median sale price sits around the $400K to $500K range. Those aren't tiny wobblers. This is a real pullback compared with pandemic peak levels, and it's important because pricing sets everything else, from affordability to investor math to how desperate sellers become. Inventory, the secret sauce, has changed the game. After years of bone-dry shelves sellers loved, listings have swelled. Months of supply are hovering in neutral territory, leaning slightly toward buyers. When inventory sits around 6 months, prices tend to stabilize or fall, letting buyers shop with leverage. Rents? Tenants are suddenly wielding bargaining power. Active rental listings have jumped, and median asking rents have eased from their peaks. Some reports place median rent around $2,050 in late 2025, down more than 10% from peak summer 2023 numbers. That affects investor yield math and landlord flexibility, and renters benefit with more choices and negotiation room. Interest rates are the backdrop puppet master. Mortgage rates have fallen from the panic highs of near 7-8% territory and now sit roughly in the mid-6% range. That's lower than some earlier peaks, but still above the ultra-cheap rates of 2022, 2021. So buyers have more breathing room, but affordability is still constrained versus the pre-pandemic era. Why Austin? 3 forces collided: rapid pandemic-era population growth and investor frenzy, heavier new construction in some parts of the region, and then a demand cool-down, fewer transplants, more remote work recalibration, and macro headwinds like consumer uncertainty. Weak absorption rates and a high share of price cuts mean many listings are adjusting down to find buyers. Neighborhood reality check, because Austin is not one market, it's many. Central, Congress, Westlake, still premium, still tighter supply for turnkey, high amenity homes. Expect price resilience for truly renovated, walkable properties. East Austin, Johnston Terrace, MLK Corridor. Heavy new multifamily and infill supply. More choices, more price competition, good hunting for value, flips and rentals if you can prospect right. North Austin, Round Rock, Pflugerville, Suberville, Leander. Suburban inventory rose as builders slowed in core Austin. These areas show more pronounced price pressure and longer days on market, but also cheaper, per square foot math. South Austin, Dripping Springs Corridor. Lifestyle buyers still active for land and single family with yard space. Those pockets often lag or lead, depending on inventory and school zones. Numbers that change decisions. Days on market. In many neighborhoods, median. The days on market have stretched into multiple weeks, 60-90 days in some areas, versus the lightning cell days of 2022. That creates negotiation windows for buyers. Price cuts. A large share of listings are seeing reductions some months, close to 45% of listings. Sellers are recalibrating fast. Inventory change. Inventory has surged since 2022, up significantly from historic lows. The absolute months of supply is the cleaner indicator, and it sits near 5.7 months. What this means for buyers: you have leverage, contingencies, inspections, appraisal gaps. These are back in play. Don't auto-waive them unless you know the property inside out. Price negotiation is sane again. Offer with data, not emotion. Use recent price reductions on comparable listings to support a lower offer. Sellers who have been on market for months are fatigued and more open to reasonable deals. Lock smart. Rates are lower than earlier in 2025, but still volatile. Shop lenders. Consider a rate lock once you're under contract, and model scenarios at 5.75 to 6.75% to test affordability. What this means for sellers: pricing is priority one. Overpricing during a buyer's market equals wasted time. Price aggressively to attract interest or expect longer days and price cuts. Presentation and speed matter. Renovated kitchens, updated mechanicals, and a crisp inspection report pre-listing can still command a premium and speed up sales. Consider alternatives: rental conversion, lease to own, or staging as a short-term rental if local regulations allow. Flexibility can extract value when comps are soft. For investors and landlords, rents are softer. Median asking rents have rolled down from previous peaks. Vacancy and supply are real. Rerun your yield math with current rents and updated cap rates. New construction has slowed in some metrics, but deliveries and active rental listings continue. Target submarkets with constrained new supply and strong employment anchors for better long-term rent resilience. The tech and jobs angle the demand engine. Austin's job story still matters. Big tech presence, startups, and relocation headlines aren't gone, but hiring waves are more measured. When tech is hiring, housing demand perks up. When hiring stalls, demand softens. Cooling migration compared to the pandemic surge contributes to slack in demand. Data-driven negotiation tactics you can use today. Use the last 60 days of active and sold comps, not 2021 mania comps. Emphasize recent price cuts as evidence that the seller's list price exceeded the market. Include a reasonable but tight appraisal contingency timeline to keep the seller comfortable but protect your loan. Don't overgift away contingency protections. Risk signals. What to watch for. Neighborhood oversupply. If a submarket shows a surge of new for sale listings or large-scale condo deliveries, prices can remain pressured. Check active permits and upcoming condo projects. Employment shocks, layoffs, or mass remote policies at major employers can depress local demand quickly. Monitor quarterly hiring trends. Interest rate shocks. If rates tick up unexpectedly, affordability drops and the buyer pool tightens. If rates fall, refi waves and increased buyer activity can kickstart bidding wars. Both are possible plan for mid-6% rate scenarios. Today, a seller's tactical checklist. Price to generate a first-week offer pool competition prevents long-tail days. Buy a pre-listing inspection to remove unknowns and speed contracts. Offer one clean seller concession rather than a price anchor. It preserves perceived value. Market aggressively. Professional photos, a 3D tour, and targeted ad spend get you eyeballs fast. A buyer's tactical checklist. Get pre-approved, not pre-qualified. Show the seller real financing strength. Build a comparables packet showing recent price cuts and absorption stats. Attach it with your offer. Ask for seller-solicited repairs to be fixed or credit at closing. Don't waive inspection without a compelling reason. Consider an appraisal contingency waiver only with a true cash deal, or if you've budgeted an appraisal gap coverage. Investment plays that make sense right now. Value-add flips where you can buy below replacement cost, rehab, and resell. With longer days on market, rehab timelines can be absorbed without frantic flipping. Multifamily in constrained submarkets, rerun cap rate math with current rents. Conservative. Buy and hold single family in neighborhoods with strong schools and limited new construction. These tend to weather downturns and attract stable tenants. Policy and city moves that affect supply. City-level permitting and rezoning debates impact long-term supply. Drops in multifamily, permits could tighten long-term affordability if demand returns. Conversely, accelerated high-density development could flood supply and compress rents. prices locally. Keep tabs on council items and mayoral proposals. How to read the next 12 months. Expect a bumpy stabilization. Prices should trend sideways or modestly down in submarkets with heavy new supply. Core renovated properties may hold firm or continue small gains. Inventory near 6 months often means some markets will flatten, while opportunistic buyers and investors sift through motivated sellers. If mortgage rates continue to ease in the mid-6% range, buyer demand could ramp and absorb inventory faster than expected, but don't bank on dramatic rate collapses. Concrete actions for each role. Buyer, lock pre-approval. Build a comps packet, negotiate hard but fairly, and don't skip inspections. Model affordability at current rates and at a plus 0.5% shock. Seller, price to reality. Fix the obvious and market aggressively. If not urgent, wait for seasonality. Spring buyers can return if rates dip. Investor, stress test rents and occupancy. Don't assume 2021 yields. Look for operational efficiencies and markets near employment hubs. Austin has shifted from a runaway seller's paradise to a nuanced buyer's market in many pockets. That does not mean everything is cheap. It means discipline wins. The macro support jobs, cultural magnetism, universities is still here, but the era of automatic price appreciation has cooled. Savvy players who use data, respect local micro markets, and plan for mid-6% mortgage math will be the winners in the next cycle. Now let's talk momentum and mindset. Imagine you're standing on the rooftop of a downtown Austin condo. Below you, cranes once painted the skyline, buyers once scrambled like it was a game show buzzer, and sellers thought every "for sale" sign meant a war zone of offers. That era, it's over. What remains is a market finding its rhythm again, not explosive growth, not collapse. A calm, measured wave, where discipline wins. For you, that means this moment is less about racing to buy, and more about sliding in smartly, or if you're selling, making the right move before the next tide rolls in. There's a psychological shift happening in Austin. Sellers used to control the pace. Now, buyers have time. They can walk, they can check, they can blink, and wait for the drama to settle. That changes behavior. Fewer emotional overbids, more realistic offers, more deals with room to breathe. You'll see this in neighborhoods where homes sit longer, now priced for negotiation. You'll feel it in listings, with fewer fireworks and more reasonable open house Sunday energy. Let's zoom out to the macro backdrop. Rates, inflation, migration. Mortgage rates, hovering in the mid-6% range, mean affordability is still a hurdle. For many, monthly payment math still stings. On the migration front, Austin's magnet still works tech jobs, universities, lifestyle, but the whirlwind growth phase has cooled. People are relocating, but not at the breakneck pace of 2022. Developers are still building apartments and houses, but the boom time urgency has dialed back. Combine that with more supply and you get a more balanced dance between supply and demand. Here's the neighborhood by neighborhood reflection. Downtown and Westlake, pristine, walkable, renovated. Here you'll see less price drop because the product is special and the buyers still pay for lifestyle. But even there, you'll catch longer days on market for properties that don't shine. East Austin and MLK Corridor, value hunting ground. Infills, multifamily, competition. If you're agile and you can rehab or lease, you'll find hidden pockets. North Austin, DO, suburbs. Builders paused, inventory rose. This is where your action, likely to find discounts or wiggle room, but also where you'll need to check for cookie-cutter homes that lost their shine. South around Dripping Springs, escape buyers still around land, yard, space. But even these buyers are price-sensitive now. And then there's the rental ecosystem. Rents are cooling. Tenants have leverage again. If you're an investor counting on 2-digit annual rent growth, that story's paused. Instead, it's about steadier returns, stronger tenants, and fewer assumption wildcards. That means for flip investors or short-term plays, you'll want to adjust your risk profile. For buy and hold landlords, it's about fine property, solid tenant base, and giving a little service edge because leverage is shifting back to renters. Now let's call out the warning signs, so you're not blindsided. Oversupply in a subzone equals red flag. If you walk into an area and every street has 3 new builds and half are still for sale, that's a saturation risk. Economic shock trigger equals red flag. Tech layoffs hit hard in places like Austin, where demand is tied to white-collar jobs. Rate jump equals red flag. A sudden shift to 7% plus kills monthly payment tolerance and squeezes buyer pipelines. Here's the opportunity checklist. If you're a buyer, bring data, bring patience, bring financial clarity. You're no longer in must-own yesterday mode. You're in smart position now mode. If you're a seller, don't rely on momentum. Create urgency. Price competitively. Show your house beautifully. Be ready to negotiate. If you're an investor, run scenarios at current rent plus small growth, 3% year, not the 10% year boom of old. Focus on markets with constrained supply and strong tenant demand. If you're a renter, you've got options again. Ask for concessions. Look at newer units, older units. Compare cost versus buying math carefully. Finally, what's next? The market ahead is less headline drama, more quiet strategic moves. Expect plateauing or modest declines in many segments, selective growth in niches. If rates slip a little, buyer activity could surge, which might reignite pricing in some areas. If rates rise or job growth stalls, you'll see more pressure, more concessions. So your best move now, stay informed, watch your local comps weekly, and act with intent, not impulse.